but I think it's not just an American phenomenon right now, but really around the world. I think about India and Hong Kong as well, with some big IPOs. And I think this is what I think the market is telling us. One is that why would a company go IPO? Why would they have an IPO? Because they think they get a lot of money for their shares. So the big rally in the stock market might be encouraging some companies to bring forward. And that's the other issue, is this year has been really one of with the COVID has been a major disruption. People are trying to, that sort of has pent up things, held things back. We saw a big flurry of activity in the tech space in September. And now I think we're seeing a broader range of industries, and especially in the consumer sector. I think that's what we're seeing here. But so I think that this is just a good time globally. You've got the political uncertainty lifted in the U.S. We've got the idea of a vaccine, which means a stronger second half of next year. So I think that we've got this tough near term. The near term risks are probably to the downside, but the medium term risks seem to be the upside. And the IPOs, I think, partly reflect companies wanting to cash in, attractive prices before the next big opportunity with the economy post-COVID. I think we're seeing both, right? Like you mentioned, Airbnb. That's clearly for the post-COVID. While they've had a tough year, as you would expect, and I think the opposite for DoorDash. So I think that there's different strategies being played out. So I think that some are trying to cash in, others are preparing for the longer situation. I do think it's like a very fluid situation. And besides the M&As, the other thing that's coming back is share buybacks. A lot of companies held off buying their own shares during 2020, and I think that both the share buybacks and the M&A partly reflects the abundance of capital that either companies have, or that the easy liquidity conditions, the easy funding conditions at such low interest rates. Yeah, so it's true that people are thinking about will gold and the cryptocurrencies compete, and I think that I doubt it, because I think that, for example, when you buy an ounce of gold, you know what you're buying, and people who buy the gold bullion, who put it into special safety deposit boxes at banks, and these are the real gold investors, as opposed to those who are buying a paper claim on gold, like I might buy a gold ETF. But the people who buy the bullion, the cyber currency is no alternative for them. Even though you might think that they're both free from the government, they're not. It's not really true. So basically, I also worry that in that cyber currency space, we still have it's a long battle that has just begun. And I think that you're going to see a lot of concern from governments about using of this as it grows, and aren't as careful about money laundering as they'd like for others. So I think that this is going to be begging for regulation for the states to still dominate this space under consumer protection. We'll have to see how it unfolds. But so far, the successful experiments, like in China and places in Europe, have really been government-sponsored, not the Facebook private sector version or a Bitcoin version. I still don't really see a lot of stores pricing their goods in Bitcoins. I see that there's some other interesting developments with PayPal, with Visa, but these are giving people the opportunity. And I'd really like to see how much people really use that opportunity. So imagine this, people have worked hard, they've saved up their money, and they want to put it for a rainy day, or maybe for the retirement. And are they going to put it into Bitcoins or Ethereum or Ripple? I think that it still lends itself more to speculation than investing. Think about how important dividends are to the return on the stock market over the long haul. No Bitcoin bonds, no yield. So you're just playing basically for price appreciation. And I can understand how there's valuation for a stock, breakup value, its earnings stream discounted, replacement costs, free cash flow. I can understand how there could be a model for fixed income. What's that value of the earnings stream or the coupon payments over the duration, and thinking about those kind of issues. I just don't understand the intrinsic value cyber currencies. We make fun of paper money because it's fiat, it's not backed by gold or silver. I really don't understand what my Ethereum is really backed by, for example. And so I really wonder, I know that some mutual funds are giving greater access. There's more interest in Bitcoin futures and funds that are just specifically invested in Bitcoin. So I think it's an interesting new thing to be looking at. That's why I'm just hesitant about drawing these conclusions that this is David about to topple Goliath. But here we are in the stock market. It's hard to see like resistance. So I do think that people are optimistic about next year. And this is really the thing that I think that the real challenge for policymakers and investors. The short term, the next several months, are still going to be heavy-hearted. The virus is not under control in the U.S. We're just beginning to see some signs of it turning, and maybe parts of Europe. It's still going to be a few months of a very difficult time, but I think people are very optimistic about, say, the second half of next year. And so I think that there is a reflation trade going on, if you will. That reflation trade, higher yields. Companies that have been adversely affected by the stay-at-home and the social restrictions. I'm thinking like Disney stock, which is sort of like, sounds kind of like old-fashioned, but it's making new highs as well. And a place that will be benefiting from an increase in tourism. So I do think that people are looking at next year more optimistically. I think that you got, like we were talking about, mergers and acquisitions, share buybacks, all very positive developments, and also stronger growth. And for U.S. companies, there's going to be a new tailwind for earnings that'll help lift earnings for a lot of multinationals, and that's been the decline in the dollar that we're seeing, say, in Q4 of this year, really beginning, say, the second around the middle of the year. So we'll begin seeing that in the quarterly earnings, with the dollar being actually adding to U.S. earnings growth of the large multinationals. And yet, what I find now is that it turns out that I might have been a little bit early, but I'm probably conservative. I sat on this panel about a month ago with Stephen Roach, who used to be at Morgan Stanley. Now he's a professor at Yale. And he's talking about the dollar, well, the euro specifically, rising by over a third against the dollar next year. And I know it's easy to dismiss one economist, but Citibank is talking about a 20% decline in the dollar. And so I see that not only have more people joined me, now I think my bearish dollar view is really consensus. And that it's almost like my industry is like chasing themselves, trying to who can be more bearish toward the dollar. It sort of scares me a little bit, but I sort of have to favor still the downside, thinking that the twin deficits, the budget deficit and the trade deficit, is going to be the framing of the dollar's decline next year. So I think that's what we're really talking about, not so much direction, but how the magnitude.